Greetings, class, and welcome back to Chapter 6. In this chapter, we're going to look at variable costing and absorption costing, and basically how we look at segment reporting. Segment reporting is very important, especially in larger businesses, but we're going to talk about how we do that using a couple of different approaches. So the first approach we're really going to look at is variable costing, and that's going to be very familiar to you because it's very similar to what we've been doing in Chapter 5. And prior to that, we're looking at variable costs versus fixed costs. And then we're going to also look at absorption costing and see how that differs from variable costing. And then we're going to prepare income statements using both methods and then reconcile the difference between variable costing and absorption costing net income and explain why those differences occur, and then also look at segmented income statements and how we identify those costs that are traceable fixed costs from common fixed costs. What are the difference between those? And then we're going to compute company-wide and segment break-even points for a company where we have traceable fixed costs. So we'll go ahead and get started with this chapter. First of all, variable costing, like I said earlier, under that approach, the manufacturing costs that vary with output are treated as product costs. Now, if you remember in Chapter 5, when we were calculating break-even points, this is exactly what we were doing. So this is what we were doing in Chapter 5 when we were doing cost, volume, profit analysis. And so this should be very, very familiar with you because in this variable costing approach, we're going to consider the cost of raw materials, the cost of direct labor, and the cost of variable manufacturing overhead as product costs. The fixed manufacturing overhead is not a product cost, it's a period cost. So it gets moved down to the cost below the contribution margin calculation. So we'll take the sales in this method minus the variable cost of raw materials, direct labor, and variable manufacturing overhead to get contribution margin. And from that, we'll subtract out all fixed costs. So under this method, we're interested in the contribution margin before fixed costs and identifying how we use those fixed costs and the contribution margin to calculate a break-even analysis. For absorption costing, we're going to consider all manufacturing costs to be product costs, regardless of whether they're variable or fixed. So we're going to have the cost of a unit of production or a unit of product. Under absorption costing, we'll have direct materials, direct labor, and both the variable and fixed manufacturing overhead. So absorption costing is going to allocate a portion of the fixed overhead to each of the units that we're producing, along with the variable costs. So absorption costing is going to include all of those manufacturing costs. We're going to call it absorption costing or full cost method. And then that's exactly how we'll account for. That's how they differ. So variable costing includes fixed manufacturing overhead in period cost, not product cost. Absorption costing does the other way around, where we identify fixed manufacturing overhead as a product cost, not a period cost. Selling and administrative expenses are never considered product costs regardless of how we're doing it. So under the absorption and variable costing methods, those are always going to be considered period costs, and they're going to be reported after we calculate what we might consider to be the contribution margin, or they're going to contribute to what we'll have outside of the manufacturing costs. All right, now if you want to look at the differences between the two, they have this nice chart here in Exhibit 6.1 where you can see the costs and where they're assigned in the balance sheet. And this is basically going to be very familiar to you. The difference is, you notice, this is what we've been doing right here. The raw materials, direct labor, and variable overhead all goes into work in process or raw materials inventory. But fixed manufacturing overhead, the way we've been doing it, we put it over here in period costs along with selling and admin costs. Now, however, if we're using absorption, we're going to put fixed manufacturing overhead in work in process, and that basically will go into, automatically feed into the cost of goods sold that we have. So rather than the difference between variable and absorption costing will result in a higher cost of goods sold at this point. So non-manufacturing costs, they don't change. We've been using selling and admin costs have been considered period expenses all along. We won't change the way we treat them. So here in the book on page 260, they have an example of the variable and absorption costing and how that will work. And they use this company, Weber Light Aircraft, that manufactures small aircraft. The selling price of an airplane or aircraft is $100,000. They show the direct material and labor, fixed overhead, and then the variable selling and admin expense, and then was it right here, fixed overhead here, and then we have fixed selling and admin here. Now, assuming in this example we have one aircraft produced in January and one sold in January, two produced in February and one sold in February, and then in March we have 4 units produced and 5 units sold. So that will make a difference into how we actually calculate this out. So if we're looking at variable costing and we're looking at unit costs, what we're going to look at are the direct materials, direct labor, and variable manufacturing overhead. And we're very familiar with how to do that. So what that means is we have a total unit product cost per unit of $25,000. So it's going to cost $25,000 in variable cost to produce an aircraft. All right. Now, if we look at and use this as cost of goods sold, which is what it would be, we recognize the unit product cost in January is $25,000 because we sold 1 unit then. So when we're looking at it, variable costing, the unit cost of goods sold is $25,000. February, it's the same thing. We sold 1 unit here, so we have cost of goods sold of $25,000. And then in March, we have 5 units sold. So that makes our cost of goods sold $125,000 under the variable method. Then we're going to have variable selling and admin costs, and that's going to be at $10,000 per unit sold, and then fixed selling and admin costs. And then we'll have a total selling and admin expense. Now, as you can see, just by looking at this, you're going to have a loss in January, but you're going to return to a profitable status in February, and in March, you're going to have a significant increase in your net income. And that's all the variable costing method. Well, let me go down here and show you. Actually, we're going to have a loss in February too, because we only sold 1 aircraft in February as well. I didn't fully consider all the fixed costs. So what we have here in January, we have $100,000 in revenue. We have all these variable costs here, $65,000. But with our fixed costs that come out of $90,000, we have a net loss of $25,000. And since we sold the same units in February, we'll have the same loss in February. However, we get to March, and you see there's a big change because we sold 5 units for $500,000. We have the variable costs adjusted based on what we were calculating, and then the fixed costs do not change. See, we sold 5 aircraft, but still we have this amount of cost, $90,000 in fixed. So our profit's going to be much higher, $235,000. So when we look at the contribution margin per aircraft, which is really what I was considering before compared to the fixed expenses, looking at it as if it were cost volume profit analysis, we'll have this 25,000 in variable costs for variable cost of goods sold, variable selling and admin of 10. So we have a total of 35, and for each aircraft we're going to have a contribution margin of 65,000. And then we'll have the fixed expenses of 90,000 per month. So we have the same net operating loss in January and February, but we have an improvement in our net income in March. Now suppose we're using the absorption costing method, and if we do that, we will have a difference because of the way we calculate the cost of goods sold and basically what manufacturing costs are. So when we're looking at this, we're going to determine the unit product cost for each month. So if we look at January, we have direct materials, direct labor, variable manufacturing overhead. This doesn't really change from the variable costing method, but we calculate the fixed manufacturing overhead of $70,000 divided by 1 unit produced in January, and that's $70,000. So we're going to have $70,000 per unit. When they do this division, they're basically looking at a per unit cost for the fixed overhead. And then our unit product cost will be a total of $95,000. So what happens is when we get to February, we actually produced 2 units. We only sold 1 of them though. So when we produce the 2 units, these costs are going to remain the same. However, when we get to fixed overhead, we're going to divide that fixed overhead by 2 units. So the per unit cost goes down, drops significantly to $35,000. Our overall cost drops to $60,000 because in this month we produced 2 units. Now it really shows a significant difference from January to March because here we produce 5 units. So we take these direct materials, direct labor, and variable manufacturing overhead, and then we take the fixed overhead cost divided by 5 units, or I mean 4 units, not 5. So that gives us 17.5, which is a far lower number for fixed overhead. And you can see the unit product cost drops significantly again. Now, the manufacturing overhead, fixed manufacturing overhead, and absorption costing, this is a phenomena of this method. And in the beginning story in the chapter, they talk about why do they keep producing product even though they're not necessarily selling it all. This is why, because by using absorption costing, the per unit fixed overhead drops if they continue to manufacture at a higher level. Now, if we're looking at the income statements, there will be some difference here as well. Notice in January, we have 1 unit sold, 100,000. The cost of goods sold is for 1 unit is 95,000. So we take that out, and we have a gross margin of 5 in selling and admin, and we have the same results in January that we did in January under the variable cost method. However, when we're looking at February, we have a different cost of goods sold. Remember back here we were looking at the cost of the units, and when the cost per unit dropped, that's what our cost of goods sold is. So we see the unit cost here of $60,000 is much lower than the original 95 using absorption costing because we're taking fixed overhead and dividing it by the number of units produced. Well, because of that, we come here to the absorption costing income statement, and we start with the sales amount of 100,000, take out the cost of goods sold per unit. Now it's dropped from 95,000 down to 60,000. And so, by the way, that's one unit that was sold. We produced 2 units, but we only sold 1. And under the absorption method, we're going to record the cost of goods sold when we actually sell the unit. So here, only 1 unit sold. What it effectively does is it drops our fixed overhead costs in the month of February enough that we actually show a profit. So we have a gross margin then of 40 instead of 5. We take out the same selling and admin costs and we get a $10,000 profit. Now in March, again, this is going to show an improvement because we're taking the cost of the sales and then the cost of goods sold. And remember, in March, we calculated a cost per unit sold of $42.5 because, once again, we divided the number of units or the cost of fixed overhead by the number of units we made, which is 4. So we get a cost per unit of $17.5. That gives us an overall cost of goods sold for each unit of $42.5. So we get down to the bottom here, and we're going to say, okay, now with the cost of goods sold, we have 5 units sold. Or no, 4 units, I guess. Oh, no, we have 5 units sold. So what we're going to do to calculate this cost of goods sold is we'll take 1 unit at $60,000 because that's the cost of goods sold in February, plus 4 units at $42.5, which is the cost of goods sold in March. Notice that the cost of goods sold under absorption costing changes from month to month depending on the amount manufactured. So, because in absorption costing, we're going to divide out the fixed overhead by the number of units, each month the cost of goods sold will change. So for the month of February, it was 60 per unit, and in the month of March, it's 42.5 per unit, which is from the schedule up here. We just bring that down here to do the calculation. So 1 unit times 60,000 plus 4 units times 42.5 gives us 230,000 in cost of goods sold, a gross margin of 270. And now when we get to selling and admin expenses here, we have 70,000. We have a net income of 200,000. So again, that's based on the absorption costing method. And I've highlighted this important section here underneath this exhibit. And I know you can read it, but I'm going to go ahead and read this because I think it's very important to reflect on this because this is an important difference. Note that even though sales were exactly the same in January and February, and the cost structure did not change, net operating income was $35,000 higher in February than in January under absorption costing. This occurs because 1 aircraft produced in February is not sold until March. This aircraft has $35,000 of fixed manufacturing overhead attached to it that was incurred in February, but will not be recorded as part of the cost of goods sold until March. Contrasting the variable costing and absorption costing income statements in Exhibits 6.2 and 6.3, note that net operating income is the same in January under both methods, but differs in the other 2 months. And we'll discuss more about that in the subsequent parts of this chapter. But also note that the format of the variable costing income statement is different from absorption costing because absorption costing categorize cost by function rather than variable or fixed. So that we're really looking at whether these costs are a part of the manufacturing cost or a part of the period cost. So reconciling these 2 approaches. So let's go down here to this highlighted section. I think this is pretty important. And again, I know you can read, but I'm going to go ahead and go through this. So in general, when the units produced exceed the units sold, and hence inventories increase, net operating income is higher under absorption costing than variable. This occurs because some of the fixed manufacturing overhead of the period is deferred in inventories under absorption costing. In contrast, when the units sold exceed the units produced, and hence inventories decrease, net operating income is lower under absorption costing than under variable costing. And this occurs because some of the fixed manufacturing overhead of previous periods is released from inventories under the absorption costing method. When the units produced and the units sold are equal, no change in inventories occurs, and absorption costing and variable costing net operating incomes are the same. So variable costing and absorption costing net operating incomes can be reconciled by determining how much fixed manufacturing overhead was deferred or released from inventories during the period. What that means is basically, like in the example we looked at first, if a unit was manufactured in February but not sold until March, you're deferring that costs for that unit. So we're going to think about that here. Now, the reconciliation is shown here. So we look at the reconciliation of variable costing and absorption costing. We start with variable costing, net income or loss. There's no difference between the two for January, so you have the same net loss in absorption costing. In February, what you're doing is you're adding fixed manufacturing overhead that's being deferred until March under the absorption method. So you start with a loss in February, but this $35,000 difference really relates to the one additional product that was manufactured. And remember, we divided the fixed overhead by 2 instead of 1. Therefore, the fixed overhead was cut in half, and this $35,000 then is deferred out till March. So because of that, the difference between variable and absorption is $35,000. And so we show net income and absorption at $10,000 at that month. Then in March, the problem, we're going to reverse what we need to do, because in March we have the variable costing net income here. But again, we're going to deduct fixed manufacturing overhead here because we're releasing one of these, the product that was the aircraft manufactured in February. We're releasing that from inventory in March, so we count that in the cost of goods sold. So that $35,000 that we reduced this by here in February is added or is deducted in March, because so in February we added it back in because we didn't sell it. In March we're deducting it out because we did sell it. So basically what this is a timing difference between variable costing and absorption costing based on when the units are sold. So in variable costing, again, manufacturing overhead that's fixed is not a part of the product cost. but in absorption costing, because it is, the difference between the two methods is going to be how much of that absorption cost is recognized in the month for the units sold. And that will be here, the $35,000 that we deferred because we didn't sell that extra unit. And in March we did sell it, so we have to add it, or have to deduct it back out. I hope that makes sense. Actually, the formula here is pretty good. The fixed overhead deferred or released from inventory is equal to the fixed overhead in ending inventories minus the fixed manufacturing overhead in beginning inventories. So that's simple calculation. Just remember that when we're looking at that, we need to think about, okay, manufacturing overhead deferred or released from inventory is equal to the fixed manufacturing overhead in ending inventories minus the fixed manufacturing overhead in beginning inventories. Now, Exhibit 6.5 is really good, and I'm going to point you in this direction because this will help you understand the difference between variable and absorption methods. So they have these three different scenarios. The units produced are equal to the units sold. What is the effect on inventory? Absolutely nothing when you have the units sold being the same as the units produced. And in this case, variable costing and absorption costing will give you the same net operating income. So there is no difference between the two approaches. But if the units produced are greater than the units sold, the inventories are going to increase, and the absorption costing net income will be greater than variable costing net income, because you're deferring part of the cost of goods sold until the period in which they're sold. However, if inventories decrease, that means the units produced are less than the units sold, then absorption costing net operating income is going to be less than variable costing net operating income, because you are recognizing in cost of goods sold some of those deferred costs that you didn't count earlier. So by increasing the cost of goods sold, you are decreasing the net operating income. So I hope that helps with understanding the difference between the two. Now, there are some advantages of the variable costing approach. One of the obvious ones, I think, after working through Chapter 5 the way we did, is this cost volume profit analysis, the CVP analysis that we're going to do. Now, because of the CVP analysis, we have to break down costs between variable and fixed to calculate target profit, sales, break-even analysis, or anything like that. So cost volume profit analysis based on variable costs requires that we use or calculate some kind of a variable cost income statement. So, and the calculation here is based on these facts. This is the example we had earlier, the light aircraft company, where we sell each unit for $100,000. We have a contribution margin of $65,000, a contribution margin ratio of 65%, and fixed expenses of $90,000. So if they want to have a target profit, and here they're targeting $235,000, that means they have to sell $500,000 worth of good in order to make that. Now, they can another advantage to variable cost calculations is that it explains changes in net income or net operating income. So when we look at variable costing, it's very clear, it's very easy to understand. With all things the same, when sales go up and net operating income goes up, when sales go down, the income drops. But the number of units produced are not necessarily going to affect net operating income. What is going to affect net operating income is the number of units sold. Absorption costing statements can be a little more confusing because we're including fixed overhead in product cost, and it's not as clear the relationship between the products manufactured in the net income or the products sold in the net income. It takes a little more to figure it out. Also, variable costing is useful when you're doing analysis, differential analysis, to figure out what kind of a decision you want to make. Certainly is helpful. Okay, when we talk about segmented income statements in the contribution approach, what we're looking for is traceable fixed costs of a segment versus common fixed costs of a segment. So when we're looking at traceable fixed costs of a segment, it's something that is a cost that's triggered because we have that segment of business. If the segment didn't exist, the fixed cost would not have been incurred, and therefore, if the segment were eliminated, the fixed cost would also disappear. So they give some examples of traceable fixed costs here. They talk about the salary of the Fritos product manager at PepsiCo That's a traceable fixed cost of the Fritos segment. That certainly makes a lot of sense. The maintenance cost for the building in which Boeing 747s are assembled is a traceable fixed cost of the 747 business segment. I don't think they make those anymore, but anyway, going on. The liability insurance at Disney World is a traceable fixed product cost of the Disney World business segment of the Walt Disney Corporation. So when we're talking about Disney World, we're talking about one specific location in Florida. A common fixed cost is a cost that supports the operations of more than one segment, and you can't trace it either in whole or in part to any one segment, even if the segment were eliminated entirely, you would never eliminate that cost. So, for example, they give you some here: the salary of the CEO at GM, the cost of heating a Safeway or Kroger grocery store, and that's a common fixed cost of all the store's various departments. The cost of a receptionist's salary at an office shared by a number of doctors, that would be a common fixed cost. When we talk about common fixed costs, we're talking about costs that you cannot differentiate between different product lines, and they may be used by multiple product lines. For example, a central office building would be another one that would be like that. So when we talk about a segment margin, what we're really looking at is calculating a net income or contribution margin, basically based on the traceable fixed cost of a segment from the segment's contribution margin. So we calculate the segment's net income, variable costs, and we have a contribution margin, and then we take out of that any traceable fixed costs, and it represents the margin that's available after the segment has covered all of its own costs. When you're looking at segment margins, these are important because you're looking at whether that segment is profitable or not, and whether you want to continue to have it in the business. Now, some of the things to consider, that's not the only thing to consider, but it is an important concept to think about when you're looking at whether or not a segment of business continues. Another part of it, though, and this is a big part of it, is how much of the fixed costs that are not traceable does that segment help cover. I mean, if they're making a profit, it's not what you want, but they're making a profit. They are contributing to these other overhead costs that are not traceable, that are common shared costs. So when we identify traceable costs, we're looking at items that are in that segment, costs that are fixed, that relate to or are caused by the existence of that particular segment. So it's not always easy to determine whether or not that cost is fixed and traceable or not, but and it does take some effort, but you can usually identify or attempt to identify what those costs are. Traceable fixed costs can also become common fixed costs. So if you say I have a traceable fixed cost in this segment, there may be some cases or examples where it becomes a general or a common fixed cost. And they give the example here of United Airlines flying from Chicago to Paris. They charge them a landing fee at Charles de Gaulle Airport in Paris. And so that landing fee is a traceable cost of the flight, but it's a common cost when you're talking about what kind of tickets you sold on the aircraft. So, for example, it's a common cost to first class versus economy class or business class. So you don't have a differentiation between those three classes in a fee. The fee goes to all three as a common cost, but you are able to trace that cost to a specific flight in that business segment. So whether or not you have any tickets sold in first class or business class, you're going to pay the fee regardless. So it's not a traceable cost. Now, when we're talking about segment income statements, they give you an example here at Profit Max, a variable costing income statement here. And then they show you this kind of this structure, these two divisions. Now, in my experience at Blue Cross, when I was in the cost analysis section, we had four divisions where we prepared these segment income statements for and did an analysis of. So we have here two divisions, business products and consumer products. And so that's how we're going to break this income statement down into the two segments. Now, we also can break this down into the consumer products division to two product lines, and we have two different types of sales channels. So we can analyze this by product line, which is often done, by the way. So if you're looking at two divisions and one division has multiple product lines, you can actually analyze each product line to figure out what those costs and what the net income and the contribution margin is for each one. So let's look at their income statement to show you how they do this. So we start with segments defined as divisions. So we have two divisions in the company, business products and consumer products. We show the net income for each and then the total company net income. And so then we take this net income from consumer products and break it down between the two product lines, clip art and computer games, and we show that difference here. Notice we have the traceable fixed expenses here of $70,000, and we've identified exactly where they go and which product line. Here we have the common fixed expenses that you can't trace to individual product lines. So when we break down this computer game based on sales channels, again, what we're going to do is we're going to take these sales and the costs associated with them. We have sales of $125,000. We're going to take that down and we're going to break it out between online and retail stores. Identify, based on those costs, based on those sales, the variable cost between those two units, the contribution margin between those two sales channels, and then the traceable fixed expenses. And again, we wind up with a sales channel segment margin. But again, we're going to have some common costs that we cannot trace to either one. So we kind of put that in out here in total. But when we're looking at per unit or per sales channel or per product line, we're not necessarily going to look at those common untraceable costs. By the way, this is very similar to those divisional statements we used to prepare for the four divisions we had at Blue Cross. So, with that said, we're talking about segmented income statements. Why are we doing this? Well, we can calculate break-even analysis per segment, but we're also going to use those segmented income statements for decision-making and analysis. So we have an overall impact for each of those divisions. Now here's what we're looking at when we talk about break-even analysis on a segment. Well, this is for the whole company. So when we're talking about the whole company, we're talking about traceable fixed expenses plus common fixed expenses divided by an overall contribution margin ratio. That's a fairly straightforward calculation to figure out. Now, if we're going to calculate the break-evens for a segment, we're going to drop off these common fixed expenses. We're only looking at the segment traceable fixed expenses divided by the segment contribution margin ratio. That's going to be different. We're going to show that here. This is our break-even analysis for a segment. So again, if we were looking for that break-even analysis, we're taking segment traceable fixed expenses divided by segment contribution margin ratio to calculate it. Okay, some of the problems that happen with segmented income statements is the omission of costs. Some costs are maybe not included that should be, and that can be a problem. Now, there is an issue that they address in the book here related to having two cost systems, variable and absorption. Many companies, instead of having two cost systems, just go to an absorption method because absorption is required by GAAP for external reporting. So they may be not looking at all of the costs because they're going to that approach. But if you're thinking about these costs in terms of manufacturing versus non-manufacturing, there are going to be some non-manufacturing costs that are just as critical in determining the profitability of products. There may be some inappropriate methods to assign traceable costs among the segments. So you can fail to trace the costs directly, or you can use an inappropriate allocation base. So an allocation base, by the way, would allocate these traceable costs between product lines or even divisions based on some kind of a meaningful statistic. And we can talk about that more in class, but when we're talking about an allocation base, we're talking about something that makes sense. So in the example of the United Airlines flight landing in Paris and paying this fee for services at the airline, at the airport, a way to allocate those costs between first class, business class, and economy would be the number of tickets sold on that flight or on those flights. So you develop a ratio between the three tickets and you allocate those costs to those different, well, those would be like product lines really instead of division. But that's what we're talking about. An arbitrary basis would be just making something up that sounds good. It would not really be not necessarily something that would be based on operations. So when we talk about allocation base and we're looking at this, we want something that connects with what we're actually doing in that segment of business. And this would be what we would call a cost driver. You know, does this allocation base drive the cost of this particular flight? And if we're looking at ticket sales, it would make sense because that's going to have a lot to do with the costs that we incur. And then there's some issues, or can be some issues, with arbitrarily dividing out costs that are common costs between segments. And the example they give is the corporate office building, and how do you allocate that? And they talk about no single product is likely to be responsible for any significant element of that cost. And even if a product were eliminated, there would be no significant effect on basically whether or not that corporate office building continued to function or not. So the allocation of the corporate headquarters buildings to any product line would have to be some kind of arbitrary division of costs. There's not there could be common costs allocated on the basis of square feet or something like that. I don't know. But anyway, those common fixed costs that a manager cannot control or manage are the responsibility of higher level managers, not the manager in that particular product line. So when we're talking about these statements, again, I mentioned this earlier, but absorption costing is required by GAAP for external reporting, and it's also required by International Financial Reporting Standards. And those two requirements, in a lot of companies' minds, means rather than run two different costing approaches or two different costing systems, they're going to use the absorption costing method. Um, but that's going to be about it for chapter 6 here. You see this summary here at the end. And it basically says here, this highlighted section, because absorption costing treats fixed overhead as a product cost, a portion of the fixed overhead is assigned to each unit as it is produced if units of product are unsold at the end of a period. Then the fixed manufacturing overhead cost attached to those units is carried in ending inventory on the balance sheet rather than being recognized as an expense in cost of goods sold on the income statement. When they're sold, the fixed overhead cost attached to them is released from the inventory account and recorded as a part of cost of goods sold. This is exactly what we were talking about earlier in the difference between the two methods. Thus, under absorption costing, it is possible to defer a portion of the fixed manufacturing overhead cost from one period to a future period through the inventory account. That's probably one of the more important ideas or concepts to get a hold of in this chapter. Anyway, that's it for chapter 6. Again, there will be another video for chapter 7 coming soon, and I look forward to seeing all of you in class again. Take care.